Good morning, everyone, and welcome to our session, How COVID Broke the Conventional Cash Visibility Model. My name is Katie Bolt, and I'm the Business Development Associate at Alere. Just a couple reminders before we start today. All session recordings and the links to the CTP CCM credit assessments will be sent out next week, and I also will be sending out today's session assessment and the link towards the end of the presentation. And finally, all attendees are going to be on mute. And please submit any questions you have in the Q&A portal at the bottom of your screen, or you can feel free to chat them to the panelists. And with that, we're going to get started with our session presented by Dayton Paul. Mr. Dayton Paul is a senior consultant with Alere's ERP Treasury practice, and he has helped clients implement effective changes to their Treasury departments and has consulted on a variety of topics, including cash management, forecasting, organizational change management, and portfolio management. And now I'm going to pass it to Dayton Paul to start the presentation.
Thanks, Katie, and thanks everybody for joining this morning. So we're going to go ahead and hop into some of the topics that we're going to cover today. We're going to do an Alere introduction and industry experience, as well as some very interesting topics around the historic cash and capital impacts during Black Swan events. So taking a look at some of the events that have occurred within the past 50, 60, 70 years that have really impacted the macroeconomic markets, and take a look at how COVID-19 is specifically different. Then we'll talk about some of the non-Treasury impacts that we've seen to cash, so things along the lines of business operations and continuity, and how we can help manage those external risks from a Treasury perspective. We'll then hop into augmenting some financial processes just to improve our cash visibility and some of the tools that we can really utilize there to help improve our overall cash management processes. From there, we'll look at some of the centralized cash reporting and management capabilities and our advancements in cash visibility that we're beginning to see within the past few years that have really taken off with some of the issues that have really precipitated around COVID-19. For Alere, we're celebrating our 15 years in business. We have 250 plus clients that we are trusted advisors with and help them on all sorts of roadmap engagements, engagements for software enhancements and implementations, as well as remaining that trusted advisor well after the project is concluded. We also work with some of our great partners to really deliver some impactful change to every client that we work with, from Oracle to Swift to Kyriba and FIS. We really value everything that we do with them and with our clients specifically. Some of our practices that really focus on those impactful changes to Treasury and the business as a whole really center around our Treasury advisory services, cloud implementation services, ERP implementations, and then TMS managed services as well. Some of the clients that we have helped throughout those implementations and engagements are pictured above. So just a quick overview of some of our valued clients as well. As we hop into some of the dynamics around the historic cash and capital impacts during Black Swan events, and for those, I'm sure everybody is pretty familiar with the term Black Swan event, but just to give a quick recap, that's really an event that is aberrant, that hasn't been seen before, that really indicators weren't able to predict beforehand, that maybe people think about a lot in hindsight and try to explain why they happen, but prior to them actually happening, it was ultimately hard to predict and ultimately hard to actualize what was going to occur, whether it be in a business sense, in a market sense, or in really any sense of overall business as a whole. Some of the metrics that I think are some of the most impactful around how COVID-19 is actually different to some of the other recessions and market events in the past that we're going to cover today are centered around a lot of corporate cash flow, dividends paid in cash or assets, amount of just pure outstanding debt, and then I'll lump two together, the corporate share repurchase and our total cash in U.S. banks. Each one of these is going to tell us something a little bit different and give us a little bit different of a picture here. Unfortunately, this data isn't available enough to go back to the last time that a pandemic caused some sort of economic recession. These data sets are straight from the Federal Reserve Economics Desk that have been adjusted for inflation by our team to give us a look back through the periods of data available So of course, the only other event that would compare in 1918 during the Spanish flu epidemic is not available, but we can take a look at some of the other big market impacts that occurred in these areas throughout the past 70+ years. The first one that we'll take a look at is our corporate net cash flow, which really gives us an idea of basically what corporate net cash flow totally entails. The availability and profitability of our business to keep cash on hand and use it for either investment purposes or for purposes of expanding operations or pure dividend payouts, really anything centered around cash flow. We can see there are a couple of steep drop-offs, but probably the most precipitous outside of the aberrant circumstance in 2017 has been our circumstance around COVID-19. We can see that some of the other periods of economic recession that are really pictured here didn't have a substantial or long-term impact to the net cash flows on aggregate corporations across the US, but we can see that COVID-19 so far really has, and these data sets are continuing to be ongoing. So even as we kind of go through this, we'll see that some, go a quarter further, are pictured out to our September timeframe now, and we can see that the events are exaggerated even more and exacerbated. And once again, all of these metrics are going to be inflation adjusted. Unfortunately, they aren't adjusted for population increase, which would give us a very clear comparison, but since population is a factor in overall economic growth along with capital and productivity, those were not narrowed down. So these are not per capita perspectives, these are aggregate perspectives. So as we go through this, also keep that in mind that these certain items and certain representative statistics are going to be on an aggregate level. As we hop from our corporate net cash flow, we'll see really where this graph starts to get a little bit stark. So we can see that our dividends paid over the last half century plus have generally increased. We've seen certain periods of real economic fluctuation, beginning with the dot-com bubble, but we can see that really during COVID-19 and then prior during our interest rate fluctuations in 2017 and 2018. Those are some of the sharpest drops that we've seen in the overall dividends paid market. Of course, this is on that aggregate level again, but we can see that those other economic shocks, even in 2008, didn't have the same sort of impact. And there was ultimately a few other recessions as we look back through the 80s and early 90s that did not have a huge impact on dividends paid. The whole idea around dividends paid and a lot of things that circle around within the investor relations departments within each business is really centered around the idea of that dividend signaling theory. So we know that if dividends are sort of falling off, then the uncomfortability of Treasury and investor relations within those departments, there is some cause for concern there. We know that they aren't as open to maintaining dividends to incur losses elsewhere, and I think that is an important signal to keep in mind, and a very impactful signal too. A lot of companies and a lot of groups really try to retain those dividends at a high level, just so that they can signal to their investors that it is at least favorable market to come. There are favorable business perspectives, and to remain in certain index funds that are indicative of high dividend yields. So we can see that COVID-19 has really had a major impact there, as well as the interest rate curve that inverted in early last year. As we hop into some of the other metrics here, we can see that there are some interesting things that have been happening with corporate debt as a whole. As business perspectives and businesses continue to grow along with population in the US, debt overall isn't a great indicator of overall economic activity, just because you would expect as companies got larger, more profitable, and productivity grew, their debt would also grow, which we substantially saw basically since 1952 onwards. Really the only thing to note on the lower graph here is that pretty much post-recession up until 2008, there have always been short periods of debt payoffs where companies got very conservative in terms of their perspectives, at least in the short term, and tried to button up a lot of cash availability come the next Black Swan event. We can see it in 2008. That really didn't happen because of the low interest rate and availability of a lot of cash due to quantitative easing. We saw pretty much an explosion of debt from 2008 onwards, and we can see that that has really continued to grow pretty substantially. As we look at the overall quarter-by-quarter growth rates, we can see that really there are a couple periods where the growth rates measured against inflation were negative. So inflation in the 70s and 80s, is I'm sure everybody's aware, were extremely high. So compared to the debt growth rates, we actually saw, what you'd consider a reduction in debt if you're adjusting for inflation, just because the debt was becoming cheaper because inflation was decreasing that value of the debt. Because interest rates were so low in 2008 onwards, there really wasn't that availability for your inflation rates to reduce your overall debt levels. So really the real value of debt continued to grow despite maybe a little bit lower of what you think that upper graph shows as quarter-over-quarter growth rates. As we hop into probably one of the more stark graphs here, these look at the total share repurchase agreements from 1952 to present. We can see that really there was a huge impact after the 2008-09 recession, where share repurchases kind of took off, trying to create value for investors with either excess cash financed through debt activities or through expanded revenue books. That isn't totally clear, but we can see that the total share repurchase agreements really took off. It limited the sort of cash that could be grown in U.S. accounts, and we'll take a look at that graph next, but that they should really be thought of together. Instead of either reinvesting or having the availability in sort of what would be referred to as either excess reserves or required reserves, if you're talking in a pure financial sense, it was used for things like share repurchase to increase shareholder value. And we saw a little bit, at least, of a uptick during COVID, trying to maintain positive investor relations sentiments. It really fell off a cliff late 2016, early 2017, and it's only now started to rebound as the investor perspective for COVID has really been fluctuating up and down, which is indicative of the overall markets as a whole. In comparison with that, we saw really cash in U.S. banks take off, first starting with that inflection of the yield curve in 2019, and then really ballooning here in 2020 with COVID-19 taking off. This is showing that really a lot of cash that could be used or reinvested is really just sitting in U.S. accounts, not earning any interest on it, not being used to finance either short-term debt instruments like commercial paper or T-bills, but it is just, it's sitting. So we know that the visibility and the at least adverseness to risk right now is extremely high, and that's something that's continued onwards since this last quarter. We can see previously that it's been pretty flat, basically just small adjustments for inflation here or there, really nothing more than a 10% swing up or down depending on the quarter. But it was sort of around that COVID-19 event where we really saw it take off. So with that, we know that there are really some metrics that are all over the place here. We can see that excess cash, the key takeaways of these graphs are excess cash is being concentrated in accounts instead of reinvested, whether it's actually needed to finance ongoing operations or not. is not entirely clear, but because it hasn't fluctuated downward with what you'd consider probably higher fixed and operating costs with lower revenues, you know that the excess cash truly is just sitting there when it could be used in things like short-term reinvestment in things like money market funds, commercial paper, or T-bills, which are really risk neutral in terms of their overall payout. Then we also saw one of the other things, a drastic increase in debt in 2008. It makes our liquidity and solvency concerns greater. Whenever there's greater debt, you need the greater assets to really balance out, especially if you're talking quick or current assets, to be able to finance any short-term debt that you might have if it's not able to be rolled over into new short-term debt. So that could also be an indicator of some of the ballooning of cash that we saw in U.S. accounts. We saw that lending restrictions with certain U.S. financial institutions and banks across the world have sort of restricted within the past couple quarters. They're concerned about their books as well. They don't want to be taking on excess risk when really we don't know when this COVID-19 issue will resolve. Low yields on all sorts of interest, all sorts of debt instruments have really affected the overall strategy that a lot of treasuries and companies have been trying to make. How do you make those risk neutral investments when interest rates are so low? Basically at zero. You're not really taking on any return for the risk that you're getting, especially if you're investing in other company debt instruments and not sovereign nation debt instruments. And then we also saw some high fluctuations in dividends and available cash. We know that companies aren't using that excess cash for what they once were. They started using it for really share repurchase and dividends since the Great Recession onwards. And it's really sort of affected where we can go right now in terms of expanding the business. We're trying to maintain sort of those existing goals of the company and investor relations as a whole. So it's making us reassess sort of the overall investment horizon and investment strategies that we've thought of as important over the last decade. And it's going to change a lot about how we sort of interact with other aspects of the business and really drive value and get some cash visibility for ourselves and for every area of the business. Ultimately, it's now more important than ever to know where your cash is, project where it's going, and not just sit on it, whether it's out of concern for matching debt payments or making debt payments or really reinvesting. It's important to have a visibility into your assets now more than ever. As part of the Treasury business process, I mean, this really is affecting the treasurers in a world where there are requirements to sit on cash and pool them in excess accounts and cover a lot of costs that are really fluctuating in time. And we'll talk about some of the cost areas of the business that have been really driving some of the decisions that Treasury has been able to make. And we'll talk about some of the ways that we really need to focus on those other areas of business and really help them to get a holistic picture of sort of our cash visibility across the enterprise as a whole, instead of just what might be sitting in our accounts at any given point in time. Overall, with COVID-19 and our cash visibility, there's some things that have really impacted our financials as a whole. Some really dynamic things too that haven't really been seen previously. So we know that some of our biggest ones are really centered around supply chain disruption, whether it is a drastic surge in demand or drastic shortfall in demand. Some businesses have seen both during this period, which is really unheard of, where fluctuations are drastic. Some businesses have seen constant decline, some have seen constant incline since the beginning of this COVID-19 era. There are other issues that, of course, have been affecting us as well. Uncertain liability and default risk has been huge. Increased lending restrictions by financial institutions has lowered the availability of some of the cash markets that were available in short-term lending markets. Payables turnover. Of course, some of our partners have seen that your vendors obviously want to get paid quicker in times of uncertainty. So how do you maintain your payables turnover? Same sort of thing with receivables turnover. We want to get paid quicker in times of uncertainty. So how do we manage those relations and make sure that we're turning over receivables more efficiently and more effectively? And then we've seen a lot of cost fluctuations, whether it's variable costs or fixed costs. A lot of things have been changing. There are a lot of new factors. There are a lot of different things that really have not had to been thought of before. Usually it's a debt to availability to business operations and cash sort of perspective as a whole, and how does Treasury maintain that? But there are a lot of new variables that we have to think about. And really Treasury has become sort of an interactive hub of all your cash, all your debt, and all of the sort of visibility that you need into making those quick decisions on how to finance certain areas of the business. And with that, Treasury's areas of focuses for cash visibility have obviously changed. It's no longer just cash sitting in bank accounts or certain debt management aspects, but it's forecasting out your receivables income, your payables, both short-term and long-term, and then some other areas as well. So centered around things like supply chain and inventory management. How are we financing long-term supply chain or short-term supply chain needs, especially with demand fluctuations? Those variables are constantly shifting. And with all that, it really affects our investment management. How are we using excess cash? Are we effectively, going to the areas that we need in the business and making sure that cash is deployed to accounts effectively? Is there excess cash being used somewhere that it shouldn't be? How are we ultimately managing those investments? Some of the specific non-Treasury impacts to cash and some of the ways to manage external risk. We've touched on a little of the overarching areas like supply chain, but we'll really dive into some of the in-depth factors that have really been affecting, I think, everybody as we go deeper into sort of this period of uncertainty. Some of the new disruptions that we've been seeing around supply chain are really centered again around the constant fluctuations in the overall demand for products and services. We never know, it seems, when demand will surge or demand will fall, and it can be pretty much cyclical within a short period of time, which is very unheard of. And then how do we balance sort of the inventory cost versus our just-in-time financing strategies? If you're expecting demand fluctuations, you certainly can't wait until a large order comes in to begin acquiring raw goods or intermediate goods. You need to have some sort of projected strategy to be able to hand that and finance that. And that's where Treasury comes into play. How do we finance these ongoing changes? And how are we adjusting certain other aspects around supply chain to really effectively implement that? How are the dynamic discountings that we're offering to suppliers, how are those changing to get early payments? Can we expect cash to come in quicker because the payables department has changed that? So obviously those open communication lines. How is payables strategizing? How is supply chain strategizing? How is it going to affect our overall cash? And that's something that Treasury needs to be interactive with, to say, these requirements are going to affect us X, Y, and Z, or these requirements are going to affect us this other way. That's where scenario planning exercises come into play. It's not just a siloed business opportunity or business decision anymore. It's ultimately discussions that need to overarch the financials areas to make sure that all requirements and all strategies are being considered objectively and consistently so that everybody can make sure that they're on the same page, especially with these high fluctuations. When it comes to inventory management, that's sort of the same sort of perspective, especially with supply chain. There are a couple of unique aspects that are really dependent upon the supply chain for our inventory management. And it really comes down to financing the goods in warehouse, whether this is truly a manufacturing or a service-based. Service-based, you're talking about potential high bench rates, high people not being contracted out, things along those lines. So this isn't just pure manufacturing. This is how are you maintaining your assets, especially when demand might fluctuate. So I don't want to think of it exclusively in a manufacturing sense, because it truly is service industries, as well as intermediate business to business industries. There's a lot of demand fluctuation, and how are you managing truly your most valuable assets during this time, especially people as well. As we talk further into some of the aspects that really begin to sort of affect the workforce as a whole and Treasury as a whole, that's where it becomes a pretty dynamic conversation, and also the more difficult. So how are variable costs changing across the business? Are there high variable costs? Do we look good for periods of slowdown? Can we fluctuate our variable costs? What is going to be the effect to cash management? Do we need to find financing because our variable costs aren't going to change that much? They're pretty inelastic. Or do we have elastic variable costs where things are going to fluctuate drastically based upon demand? So we might be a little bit safer. And then, of course, where you can, attempt to see, how Treasury can help turn those fixed costs into variable costs. So things like equipment expenditure and information technology. How can we change financing? How will that look on our cash impact, our bottom line? Will it give us enough availability to finance some other areas of the business? And continuing that scenario planning across the enterprise, especially at a high level in the financial space. And with that, there's also that conversation around fixed costs. How can we really cover our fixed costs in these times of uncertainty? And what are the cash projections that are available to us? So where you can, there's always that availability to try to turn fixed costs into variable costs through things like lend-lease programs, but also comes into actively managing overhead for things like office space or open areas. Can you decrease your expenses around utilities? Can you decrease expenses by sort of shuttering facilities and going to remote work? Will that decrease, your rent expenses? Renegotiate contracts and term agreements where possible. Maybe take an extended contract to reduce monthly rates if possible. How will that ultimately impact the availability to our cash? And then be aware of, especially during events like this, some of the lending availability programs to help cover some of those fixed costs at any given time, and see how that will ultimately affect some of that cash availability and our forecasting for extended periods of uncertainty. And of course, everything to keep in mind here is centered around that availability of cash within Treasury and the need to go out and secure maybe any external debt to really help finance those, because you do want to be able to not only project costs, but come out the other end where you're in a good environment, stable environment. There's not too much short-term debt compared to current assets. So really being able to take a look and project into the future. We've talked a lot about working across financials as a whole to improve cash visibility. And I think that's really some of the most pivotal points that have really come out of the COVID era. No longer can you operate siloed within your financial space, taking data from only one area of the business and trying to make decisions, or aggregating it after it comes out of the system. It is no longer possible to just take reports from the receivables department, payables department, and then take a snapshot of your cash and make a decision out of that. You need conversations between all areas of financials. Active management of receivables and some of the active management of payables is really where this starts. How are things changing within these two departments? It's sort of the idea that you'd want to center around. How is receivables taking advantage of dynamic discounting offered? Are there active follow-ups going on? Outstanding receivables. How is this department really reacting to the given circumstances that have been presented to us? And ultimately, that really needs to drive some of the larger conversations around cash visibility and cash availability. If receivables hasn't changed their business process and things have slowed down and you're expecting longer open receivables periods, then that's definitely going to hurt your cash availability. You need to know how this department is reacting to these periods, and that sort of goes in line with payables as well. What is payables doing? Are they extending? They're trying to extend their days payable, or are they taking more advantage of dynamic discounting policies, or are they remaining stagnant? Are they remaining sort of in your status quo to try to retain the exact customer relation and sentiment that has been accustomed for a period of time? And that is obviously going to affect some of your cash as well, especially in those times of uncertainty, because everybody should be reacting, at least in a reactive sense, if not proactive in these senses as well. So everything should be changing, and Treasury should obviously be aware of that, because it is ultimately going to affect everything that the Treasury does in terms of financing areas of the business, making sure cash is available, giving quick notice to any sort of areas of difficulty or uncertainty. And that leads us to how ultimately Treasury can react to some of these unforeseen circumstances, especially during these large scale black swan events, especially now. And a lot of it is going to boil down to, a lot of your short-term versus long-term financing availability options. Whether it is purely through excess cash, and that's the strategy, you need to know how that can be best and most impactful, whether it's taking, short-term commercial paper, overnight commercial paper, to try to even get, 0.001% return. That's still, especially on large scale cash reserves, that's still, a substantial change that, could help, especially in terms of aggregate movement. And you need to find how you're going to tackle some of those short-term investments versus debt matching. Are you going to take the maturity matching strategy, or are you ultimately trying to project out, your weekly expenditures or your weekly costs, and you're going to try to match those with ultimately short-term investments that will at least give you some small yield? Ultimately, how are you attacking that, and how are you developing those strategies? And you can do that as well for your short-term as well as your medium-term and liabilities to really maximize those interest rates. And it opens you up to a different slew of potential instruments as well. You're talking about T-bills or corporate bills, and no longer just that purely short-term sort of overnight paper. So you have a lot more risk neutral, if not risk-free, since I think we all know the T-bills are referred to as sort of the risk-free rate. So it gives you that availability to sort of tackle a wider portfolio, especially when there's a lot of risk uncertainty. You want to be able to take the lowest risk instruments, especially in times where there's a lot of uncertainty, not only within our own businesses, but within external enterprises as well. And then what we've talked about quite a bit, what are the variables within the different departments that are going to impact our visibility, our cash the most? We need to be aware of what's going on across the financial space to really absorb that information and make informed decisions around it. And how are we going to continue to finance our assets? Are there changes going on? Is there something that we can do additionally as Treasury to help drive some value here? And then readjust horizons whenever you can. You can take a longer-term investment horizon or a longer-term debt horizon to take advantage of short-term interest rates, especially during difficult periods. I think that's obviously something that we all consider and all want to think about. We don't want to remain stagnant, especially when low interest rates are afforded to us. That's a unique opportunity for a lot of financing strategies to change. And obviously that becomes a little bit difficult of a conversation. Trying to readjust portfolios in difficult times can be a difficult conversation, but it definitely is something worthwhile considering. And just because it's a difficult conversation doesn't mean that it should be shied away from. And how are we ultimately centralizing sort of this cash visibility from all of our different areas to obtain true overall visibility, because we've talked about sort of a lot of what we need to do to drive towards this, but ultimately, how do you reach this level? How do you get to a point where you can see cash across the enterprise projected out, what receivables and what payables is doing, what cash management is doing, what Treasury is doing, even what investor relations might be doing. There's a lot of variables that really need to be incorporated together. A lot of it is going to come down to consolidating our data. I know there's a lot of difficulty around siloing, especially in financials data, but that's an important conversation to have. You can't exist anymore in a space that has that purely siloed data. There's too much valuable information to be gained from taking information from across your ERP system or different systems that different areas are using. Say payables is using one system to pay vendors. Treasury is using a treasury management system, a TMS, for its own operations. And then receivables is using something else. That means you really have to aggregate that data. You can't take blind insight just from each one and then try to visually interpret it using manpower. It's really ultimately combining those data sets, whether it's through a true ERP integration or through a enterprise data warehouse or analytics platform. That's something to consider, but it's definitely not something that you can just query from each one and then take a look at each query and make a decision out of. It also comes down to incorporating a lot of external system data. So maybe some spot rates from Bloomberg or Reuters to really give you an idea of where market fluctuations are going, and really incorporating that into even currency revaluations, just to make sure that you have the most up-to-date information and you're not trying to do manual spreadsheet recalculations or personal recalculations, but you're truly sort of the system is driving a lot of that and giving you a lot of the outcome information, because we have seen a lot of drastic currency fluctuations during this period as well, especially for the countries outside of the OECD. We've seen a lot of changes just within different regions as well, especially with their pegging to the USD. It's been making a lot of financing difficult. So we obviously need to incorporate that as well. And then some of the bank account and financial data. We need to make sure that that is getting a holistic picture into our into whatever system we're utilizing, whether it is a ERP system, EDW, or an analytics platform. We really need to make sure that our banking information is available to us kind of across the board, not in disparate banking platforms or COEs, but actually within a platform to give us the insight and availability that we ultimately need to drive further decisions. What that ultimately leads to when you consolidate all this data is real-time insights into cash and your liquid assets. You're available to access all this information at any given time, at any point, and cross-compare. And these tools are available now. I mean, there are things like Kyriba, PeopleSoft Cash Management, FIS. It's all stuff that can give you this access. A lot of it comes down to strategizing. Of course, there are some more complicated discussions and a lot of more aggregate multinational businesses that might require something in addition to sort of that pure ERP view. And that's where we really start to talk about big data and some of its applications, where you're taking a lot of information from disparate sources. In this circumstance, it'd be a lot easier to leave that data unstructured if you're taking it from maybe 30 or 40 systems globally. You're trying to dump it all together, then really it would be advantageous to use more of a big data platform. But if you're just using those 2 or 3 systems, that standard integration would probably be best. So it's kind of that idea of size versus scalability. What is most adaptive for what we're dealing with today. So in terms of the bigger perspective, a lot more going on, a lot more focus in the multinational arena with tons of different platforms. That's where you're starting to see some of the big data come into play. For those that have been able to see some of our insights into big data, it's great at handling a lot of the unstructured or semi-structured data consumption. So no longer building strict APIs, no longer is it really strict extract, transform, and load processes or data cleansing, or really entire data teams that would just enter data or manipulate data to dump it into systems. This could be pretty much purely incorporated into these big data systems. In fact, they're so advantageous. Oracle has partnered with the Elastic Stack to incorporate a lot of big data insight into PeopleSoft itself, not only to drive the search framework, but to give you a lot of visualization metrics as well, and incorporate data from really across your ERP. Kind of what we've been talking about here is a lot of availability, and the tools are continuing to be incorporated. They handle massive scales too. We're talking hundreds of millions of entries a day. So definitely not something that a lot of people run into size-wise in terms of being able to scale up. These can handle a lot of material. And like I was saying, a lot of the vendors are growing. There's a lot of new players in the field as well as some existing ones like Oracle. In terms of developing new strategies, it's sort of what we talked about before, the communication between all different areas of the business. We really need to formulate, strategize, refine, test, and implement all of our new strategies based around all these metrics for COVID itself, and continue to reassess those. It's not static. The variables will change as we continue to go through this period of uncertainty and into the future. So we need to make sure that the assessments we're doing now are applicable and can be updated based on sort of the information that we get back and the feedback that we receive, not only from our analytics, but from maybe the people utilizing it as well. And obviously, there's a lot that goes into merging our data management treasury strategies together. You need to incorporate those scenarios, combine all sources of information that you can. Don't leave anything out. Even the most disparate sources of information can give you cross-comparative insights. And of course, develop tailored modeling that really fits into what you're doing internally with your ERP. Don't take the standard tools and just try to apply them right away. There's a lot that can be gained by trying to tailor fit some of these things together. And then of course, develop that overall strategy across your business to really push forward that cash visibility. In terms of the advancements that we've seen in a lot of cash visibility within the past couple of years and really accelerated now, I think a lot of even what we've covered this week is really centered around some of the enterprise reporting and visibility enhancements, making sure that you can see cash across your enterprise, whatever your short-term debt instruments or short-term liquidity metrics might be. Being able to access those is extremely important to make those quick and informed decisions. You also need to do any projected changes based upon sort of interest rate changes, especially if you have any floating rate instruments. You need to make sure that you're taking accurate assessments in basically real time, if not real time. And then you also need to be able to report on things across the enterprise, from AP to AR to supply chain to inventory management. How are those things changing, along with things like human capital management too? How are those affecting our costs? What are we looking at in terms of that overall enterprise level visibility? And then making sure that communication remains constant, whether it's between our financial intermediaries or across the enterprise. It's essential that that enterprise sort of strategy continues and that trend continues, and we make sure that that communication doesn't cease just because we get into another period of consistency. So that's something to think about as well. In terms of the enterprise reporting and visibility in terms of the accessibility, really it is pushing data from everywhere across the enterprise into areas where senior managers can consume it effectively, efficiently, quickly, and really be able to see what sort of insight is being driven from that data, especially around cash visibility itself. And it's also allowed us to push advanced forecasts and requirement assessments, what are we looking at a month from now? What changes have we seen in the past month that we need to then apply a month from now, 2 months from now, 6 months from now? And a lot of these tools give us the availability to do that. Some of the new strategies and variables that are really important to our cash visibility, especially after COVID-19. We've seen a lot of those macroeconomic metrics change. We've seen drastic fluctuations and trends that we thought were going to remain pretty consistent, like dividends paid or excess cash in U.S. accounts. We thought that would historically continue to be reinvested, but that trend has changed drastically. Some of the cash flow changes have been pretty impactful already, and we continue to expect that those will be more impactful in the future. Treasury is now relying on a lot of data from across the enterprise to make really informed decisions. And without that information from across your departments, you're really trying to make that decision with one hand, maybe even two hands tied behind your back. It's really you're only available to information that you can see right now within the Treasury Department itself. So how are you integrating with the other financial areas? How are you scenario planning and analyzing with them? And then, of course, how all those financials and financial areas are being impacted by each other, especially when we're making new decisions around our variables, our investment and debt horizons, and then how ultimately we're going to apply some of that cash visibility. So we can see that it's become super dynamic, especially if you want to stay at the forefront of some of the cash management opportunities and cash visibility needs of the enterprise as a whole. So with that, I will go ahead and open up the floor for some Q&A.
Thank you, Dayton. We had a handful of questions come through. So the first one's going to be, what metrics would you suggest Treasury uses to measure their success? Free cash flow or something else?
I would say it's really a combination, and it's distinct for each business. Free cash flow is obviously a big one. Return on your sort of investments or your excess cash is another big one. How are we best deploying that? Are we using it effectively to sort of finance debt, or are we using it just holding it in excess accounts? Are we generating return? What is our cash levels historically, and what is our overall return?
The next question is, what are some of the solutions available today that could give us new and better insight into these areas of cash visibility?
Yeah, so I think we talked about it a little bit, but some of the great tools that we have now are some of those ERP big name players, PeopleSoft, Oracle, even Kyriba and FIS. They have great tools that can help us gain some insight into our cash visibility just on an aggregate ERP level. When we're talking about really extensive enterprises that use sort of different operating methods, or subsidiaries use different technologies in different countries, then we're talking about sort of big data platforms and data analytics tools that can help us combine that information with a lot more ease than was historically available to us.
Thanks, Dayton. We have two more questions left. So one of them is going to be, have you seen any indicators or trends that are starting to revert to pre-COVID trends or levels?
Yeah, so the interesting thing is not yet. We've seen a lot of market recovery, I'd say, but in terms of overall Fed data from the St. Louis Fed, not a lot of the indicators have been returning yet. Things are still very much different in terms of aggregate enterprises. So it's something that we need to continue to watch and be cognizant of because these metrics have not what I would call, quote unquote, recovered to where they were.
And the last question is, how do we break through the siloing of data to get this true visibility?
Yeah, and that one's an interesting one because that depends a lot on sort of the environment that you're in within the overall business as a whole. So that's a lot of road mapping discussions, trying to point out the best technology that's available to you, especially when you're dealing with sensitive data. What is everybody comfortable with? because when you're trying to really analyze a lot of this, you don't want to totally forget the person perspective or the culture perspective, but you do want to make sure that you have the conversations that are tough enough to really push you out of siloing into areas where you can access some of these great tools that are available.
Thank you, Dayton. Also, thank you to everyone for submitting questions. As I'm wrapping up here, feel free to keep submitting them through the chat portal at the bottom of your screen, as well as the Q&A portion, and we can follow up with those additional questions afterwards. I also submitted in the chat portion at the bottom of your screen a link to the assessment, and that's what you're going to be filling out to get the CTP and CCM credits. And I also put a registration link for the next session, which is happening in about 9 minutes, and that's going to be the Kyriba partner session, Kyriba Connectivity Network for Oracle Cloud. So feel free to jump on that whenever you're done here. But I would just like to thank everyone for attending the session today. We hope to see you at the rest of the sessions for today, and have a great rest of your day. Thanks, everyone.